and welcome to another edition of Always Up to Date. I'm Denise and this is Yahweh. We're the co-owners of Always Bookkeeping. If you're just joining us, we're just here to share a little bit with you, and today the topic that we're going to be sharing is what should be on your balance sheet. If you don't know how we do these videos, we like to start with a quote and a statistic, and then just a little story, and then just ask some questions, and we'll try to answer them as best as we can. So the quote that we have today is from Michael Gerber, who is the author of E-Myth. And his quote is, "With no clear picture of how you wish your life to be, how on earth are you going to live it? What is your primary aim? Where is the script to make your dreams come true? What is the first step to take, and how do you measure your progress? How far have you gone, and how close are you to getting to your goals?" The statistic that we have is from CB Insights. CB Insights reviewed essays from failed entrepreneurs, and most of the entrepreneurs listed multiple reasons for failure. 42% of entrepreneurs who failed report no market for the service or product as one of the reasons for failure. 29% of entrepreneurs who failed report running out of cash as one of the reasons for failure. And 23% of entrepreneurs who failed reported not having the right team as one of the reasons for failure. So these were the three most common reasons reported, and all of the other reasons were reported less frequently. So things like pricing and cost, timing, location, things like that. So lots of times we see clients that come in and they have so many different accounts on their balance sheet, and they just don't know how to read it. And sort of like our quote, if you don't have a goal, or if you don't know where you're at with your small business, how are you going to succeed? You just, so we're going to talk about the balance sheet and how it should be organized and what kind of things should be on there, just to make it a little bit easier to read and to kind of get the information off it that you need.
Mm-hmm. So I have some questions that you might want to ask yourself when you're reading the balance sheet. So first of them is, what does the balance sheet tells us?
Yeah, so the balance sheet is going to give us sort of a little view of where we're at with our assets, what type of assets we have, what we owe other people, what other people owe us, and just kind of the equity that's in our small business.
Mm-hmm. What should be on the balance sheet?
Yeah, so on the balance sheet, we have our assets. So you're going to have current assets like your cash accounts. You're going to have your long-term assets, like if you have cars or equipment that's going to be depreciating over a certain amount of time, things like that. You have any loans on there. Mm-hmm. That includes a shareholder loan, loans to the bank, things like that. You have your payables, so like your credit cards and
how should the balance sheet be organized?
Yeah, so at the top of your balance sheet, you're going to have your assets, your current assets first. So we look at these as what's the quickest ones to make into liquid funds, right? Mm-hmm. So of course your cash in your bank, that's first. Always cash is the easiest to get to, so we have that first. Mm-hmm. Then we have accounts receivable. And just going back to the assets, lots of people just kind of put, it's not just their checking account for the corporation, but any savings accounts you have, any
corporate
investments, yeah, things like that. And then you have the accounts receivable. So those are the accounts that people are you've done the work for them, and your client hasn't paid you yet. Mm-hmm. So those are next. And then we have the assets, the things like the computers, the equipment, any kind of anything really that you need to run your business that's going to help you earn income, that's going to depreciate.
Mm-hmm. So any property, plant of equipment. There are some few exceptions where you would have any intangible assets like patents or copyright. It'll be on that part of the balance sheet as well.
Yeah, exactly. Yeah. Then you have your liabilities, your accounts payable, so credit cards, payroll liabilities. So those are like your payments, your source deductions that need to go to the CRA, things like that. And then after your liabilities, you have your equity.
So what bank account should a corporation have?
Yeah, so I think we've talked about this on another video, but really a corporation really only needs a corporate checking account that you use for your day-to-day business. And you might have a savings account. Really, you don't need a whole lot of accounts in your business. Just the main one is the operating account.
What is the accounts receivable?
So accounts receivable are, that's telling you what other people owe you. Like I said earlier, it's basically you've done the work for somebody and they just haven't paid you yet. So you send them an invoice. Once you've created that invoice, it goes into accounts receivable. Once the client pays you, then it leaves the accounts receivable and goes into your income.
What are the assets accounts?
Yeah, so like we talked about, the asset accounts are anything that you can use for business. Buildings, so if you buy a building that you work out of, that's an asset. If you drive a vehicle, we had an interesting conversation the other day with the rest of our staff about vehicles. We had a client that had like a $200,000 luxury car and wanted to know if they could put it as an asset. And so we had a discussion about whether is that really an asset for the corporation or not. So you have to kind of look at it as if what is that person doing? What is their business? I mean, if they drive around high-end clients and their job is to entertain them, to take them to the red carpet or something like that, maybe a $200,000 Audi is actually useful in your corporation and you actually do use it for your corporation, so it could be an asset. If you're a doctor or a lawyer and you just drive to your place of business and it's not really a corporate asset, you're not able to get income from use of that vehicle. And just a reminder too that with a vehicle you can only claim up to $30,000
for CCA.
For CCA.
Yeah.
That's right. Yeah. That's right. Some of the other things that go into the assets is computers, furniture and fixtures, all that kind of stuff goes into there.
So I think there's a couple of criteria of what to put as your asset. One of them is who actually owns the asset. So that's one of them. If the corporation owns the asset as opposed to the person actually owning the asset, that should be in your balance sheet. A second one is the length of time that the asset is being used. If it's a one-off, it could be an expense. For example, repairs. If you would look at a repairs and it's not, it is just a one-time cost to repair your asset, it wouldn't be added to the cost of your asset or to the value of the asset. And again, if it's a betterment, because the third criteria would be the benefits that you would get from the asset. Is it helping you generate income? So if it is, like for example, if you made your roof better, but it actually extended the life of the roof, that would be added to the value of your assets. So something that could extend it or that could have a lasting effect on your revenue generating activity, that would be considered as your asset as opposed to actually just repairs, because at that point it'll be a betterment or an improvement to your asset.
That's right.
Yeah. How many asset accounts should a corporation have?
Yeah, again, it varies from corporation to corporation. Some don't have any assets.
Mm-hmm.
There's some corporations that don't really need anything to run their business especially when they're starting out. They may rent their space. They may have just maybe one laptop or something. They don't need a whole lot of equipment that's gonna depreciate and that. But then there's other ones. I've seen one where they've had 10 sleds and there's a whole bunch of motorbikes and all stuff, the quads, things like that, but all stuff that they need for their corporation. They actually do use it in their corporation. So they had lots and maybe 25 or 30 different asset accounts just because they had so much equipment. But it's it all went under equipment, but they were all itemized.
Yeah, it's very useful to group your assets, especially when you're reading your reports.
Yeah, that's right.
What is an accounts payable?
So accounts payable, exact opposite of accounts receivable. So the accounts payable is what you're paying to other suppliers. So again, you get a bill from a supplier, you enter it into your accounting software, whatever that might be, and it goes into accounts payable. Once you pay that bill, whether it's right away or in 30 days or when you have the money, whenever you pay that, it moves from the balance sheet onto the income statement and goes into whatever the expense account is.
Can a credit card be on the balance sheet?
A personal credit card. So we don't normally put the personal credit cards or personal bank accounts on the balance sheet. On the balance sheet, we do have a shareholder loan. So if you use your personal credit card to pay for corporate expenses, we would credit the shareholder loan for those amounts rather than actually putting the personal credit card on the balance sheet. Again, we would strongly recommend having a corporate credit card and keeping those separate, keeping your corporate and personal bank accounts separate and keeping your personal and corporate credit cards separate.
Yeah,
it just makes it so much easier.
Yeah, and the only reason is that you just don't want to commingle your personal expenses with your business expenses.
Exactly. And if you ever get audited, it's so much easier to this is our corporate business card, our credit card, and we use it only for. It's so much easier than having to say, well, yeah, it was on the personal credit card, but really it was a business expense.
Yeah. What are the current liabilities?
So current liabilities, again, it's going to be your credit cards that you're paying off, your payroll deductions. So probably hopefully if you're running a small business and you have employees, when you pay your employees, you have to withhold tax and remit that to the CRA. So those are things that are on the liabilities, the current liabilities.
So on the bookkeeping's perspective, really current liabilities are just anything that you owe within the year. But sometimes if you go to your accountant and they prepare your year-end financial statements, they would have a portion of your long-term liabilities as part of the current liabilities. That just means that portion of the loan is due within a year. So it's not necessarily a separate loan account. It could be the same loan account, but just the portion or the current portion that's due within the next year.
Right.
Yeah. What is the equity?
Yeah, so the equity comes at the very end of your balance sheet, and that basically tells you kind of where you're at. And it tells you, you might have shares, you list the shares that are in the company, you want to put in there if there's any dividends that have been paid out. So that's kind of what's shown with the equity.
Yeah, so anything that has to do with the shareholders or the owners of the company, any of their contributions. So if you're a corporation, that would be your shares or your common shares, anything that goes up to you, which is dividends, anything that is coming into the business without any financing, so any of your income, which will go into your returned earnings, or deficit if you're taking out too much from your corporation. Another thing that would be in your equity, if you're a proprietorship, would be anything that you withdraw from the company, because then it wouldn't be a shareholder loan since you're a shareholder, so it gets taken out directly from your contribution to your proprietorship.
Right.
Yeah. So any contribution and withdrawal from your proprietorship would show up in your equity. Yeah.
Yeah, and just that's probably all we have about the balance sheet, but just one thing that I wanted to point out was that it's really important to review your balance sheet with your income statement. Lots of times people just go straight to the income statement because it really tells you the bottom line of how much money you've made, right? But it's really important to view both reports together. And I think we're going to have another video sometime about the income statement and just a little bit more about that. So
yeah, for sure. Well, thanks for joining us today. If you liked the video, please hit like and subscribe. If you have any questions, feel free to comment on our section and we'll get to you as much as we can or as soon as we can. And see you guys on our next episode.